Imagine you've just made a smart investment, maybe in tech, manufacturing, or even international trade. You've done your research, the numbers look good, and you're expecting solid returns. But then, bam, a new tariff is introduced, and suddenly your costs skyrocket. Your supply chain is disrupted, and your profits take a hit. Sound unrealistic? Think again. Tariffs have been shaking up the investment landscape for decades, and right now they're more unpredictable than ever. Whether it's U.S. China trade tensions, new EU policies, or shifts in global manufacturing, tariffs are a silent killer that can erode your profits before you even realize what's happening. So before you make your next big investment, pay attention, because what you don't know about tariffs could cost you thousands, if not millions. Let's break down exactly how tariffs impact investments, which industries are most at risk, and, most importantly, how you can protect your money. Before we dive into how tariffs can wreck your investments, let's define what they actually are. A tariff is basically a tax on imported goods. Governments use tariffs to 1. Protect domestic industries by making foreign goods more expensive. 2. Punish other countries in trade wars. 3. Raise government revenue, though this is often a side effect, not the main goal. Sounds simple, right? Well, not exactly. The real problem is tariffs create ripple effects that impact prices, supply chains, corporate profits, and stock market performance. And if you're not paying attention, they can destroy your investment strategy. How tariffs impact investors. If you're an investor, tariffs can affect your portfolio in ways you might not expect. 1. Higher costs for companies, lower profits. Let's say you invest in a US company that relies on Chinese manufacturing. If the US slaps a 25% tariff on Chinese imports, that company suddenly has to pay way more for its raw materials. Now the company has two choices. Absorb the cost, which means lower profit margins. Pass the cost to consumers, which could lead to lower sales if prices go up too much. Either way, investors lose because the company's earnings shrink. And guess what? Lower earnings usually mean lower stock prices. 2. Supply chain disruptions can tank entire industries. Global trade is like a giant web, and tariffs can break that web apart. Example, the auto industry. Many car companies rely on parts from multiple countries. If a tariff hits steel, aluminum, or electronic components, the cost of building a car skyrockets. Suddenly, companies like Ford, Tesla, or Toyota have to either raise prices or cut costs elsewhere, and both options hurt investors. 3rd, market volatility and unpredictability. Tariff announcements can send the stock market into chaos. When former US President Donald Trump imposed tariffs on China, the stock market plunged multiple times due to uncertainty. Trade wars between the US and Europe, India and Canada have also caused wild fluctuations. Even today, new tariffs from China, the EU, or the US can instantly make or break certain stocks. If you're investing without keeping an eye on trade policies, you could wake up one day and see your portfolio down 10% for no reason, except a new tariff announcement. Industries most affected by tariffs. Not all sectors are equally affected by tariffs. Here are the top industries at risk when tariffs go up. 1. Technology. Big tech companies like Apple, Microsoft, and Nvidia rely on overseas supply chains for parts. If new tariffs hit semiconductors, lithium batteries, or rare earth metals, the cost of making smartphones, laptops, and AI chips could surge. 2. Automobiles. Tariffs on steel and aluminum. More expensive cars. Tariffs on electronics equals higher costs for smart vehicle technology. Tariffs on foreign-made vehicles equals shrinking consumer demand. 3. Retail and consumer goods companies like Nike, Adidas, and Walmart manufacture products overseas. If tariffs increase, production costs rise, and consumers might stop buying due to higher prices. 4. Agriculture and food industry. Many US farmers export their crops overseas. If countries retaliate against US tariffs, they impose counter tariffs on American soybeans, corn, and beef. This hurts US farmers and can cause food price inflation. 5. Manufacturing and industrial goods companies, making machinery, aircraft, and industrial equipment often import parts from all over the world. New tariffs mean higher costs, fewer sales, and lower profits. How to protect your investments from tariff risks. If tariffs are such a huge threat, what can you do about it? 1. Diversify your portfolio. Don't put all your money in one sector or country. If you're heavily invested in China-dependent companies, consider diversifying into Europe, India, or Latin America to reduce risk. 2. Invest in companies that can adapt. Some companies handle tariffs better than others. Companies with strong domestic supply chains like Caterpillar or Boeing may fare better. Companies with diverse manufacturing hubs like Apple shifting production to India can avoid heavy losses. 3. Watch government policies. Like a hawk, stay informed on tariff news, trade deals, and global policies. If you hear about pending tariffs on semiconductors, be cautious about investing in chip makers. If trade talks between two countries are improving, it might be a buying opportunity before tariffs are removed. 4. Look at ETFs that hedge against tariff risks. Instead of betting on a single company, consider broad market ETFs that balance exposure to multiple industries. Some ETFs even specifically focus on tariff-proof industries, such as healthcare ETFs, less affected by tariffs, defense and aerospace ETFs, often protected by government spending, domestic consumer goods ETFs. If tariffs hurt imports, local companies benefit. 5. Keep cash on hand for opportunities. When tariff news causes panic, stock prices often drop temporarily. If you have cash ready, you can buy great stocks at a discount when the market overreacts. Final thoughts. Tariffs might seem like a political issue, but they have real financial consequences, especially for investors. They can increase costs, hurt profits, disrupt industries, and cause market volatility. But with the right strategy, diversification, smart investing, and staying informed, you can protect your portfolio and even find opportunities in the chaos. So before you make your next big investment, ask yourself, how could tariffs impact this industry? Is this company prepared for supply chain disruptions? Am I diversified enough to handle trade shocks? Because in today's unpredictable economy, smart investors don't just chase profits, they protect themselves from hidden risks. Outro. What do you think? Are tariffs a major threat to investments, or are they overhyped? Have you personally lost money due to tariff policies, or do you see opportunities in this chaos? Drop your thoughts in the comments below. And before you go, don't forget to like this video if you found it helpful. Subscribe for more insights on smart investing. Share this video so others can protect their portfolios too. Thanks for watching, and I'll see you in the next one.